In 2022, the standard 60-40 retirement portfolio had its worst performance in 150 years. Not a bad quarter, not a rough patch. According to Morningstar, it was the only time in a century and a half that bonds failed to protect investors during a stock market crash, meaning both fell at the same time and there was nowhere to hide. The portfolio lost nearly 16% in a single year. Here is the part most people still don't know. Right now, 59% of all 401k participants in the United States have their retirement savings sitting in a target date fund, and target date funds are built on the 60-40 model. That means the majority of American retirement savers are still inside the framework that just had its worst run since 1870, and most of them have no idea. The largest institutional funds on earth figured this out and moved. Here is exactly what they did and what it means for your portfolio right now. Inflation in the United States hit 3.8% in April 2026, on to the highest level in nearly 3 years. Forecasters are projecting it reaches 6% by mid year. The average savings account is currently earning 0.38%. That means if your money is sitting in a standard bank account right now, your real return is negative 3.4% per year, not flat. Negative. Your purchasing power is shrinking every single month. This continues. Most people still think of a diversified portfolio as 60% stocks, 40% bonds. That framework was built for a world of falling inflation and falling interest rates. For 4 decades, it worked like a shock absorber. When your equities dropped, your bonds rose. In 2022, both fell simultaneously. The 60-40 lost over 16% in a single year, its worst performance since the 1930s. The shock absorbers stopped absorbing. CalPERS didn't respond by tweaking their bond allocation. They responded by scrapping the entire model. They moved heavily into private equity, private credit, infrastructure, and inflation-linked real assets, targeting 40% of the fund in private markets by 2025. Here is why that matters for your money. If you own a retirement fund, a robo-advisor portfolio, or a broad index allocation, you are probably still inside the old model, not because you made a bad decision, because nobody told you the model changed. The Norwegian Sovereign Wealth Fund, the single largest in the world at over $1.7 trillion, expanded real asset and infrastructure positions across 2022 to 2024. BlackRock's 2025 investment outlook explicitly recommended reducing bond allocations and increasing exposure to real assets and private markets. The Bank of America Global Fund Manager Survey, which polls the people running the world's largest institutional portfolios, showed a multi-year consistent shift: underweight traditional bonds, overweight real assets and alternatives. And in May 2026, Vanguard, arguably the most conservative voice in retail investing, published research examining how private markets, credit, infrastructure, and real estate can improve long-term outcomes for retirement savers. When Vanguard starts questioning the 60-40, the shift is no longer early. It is mainstream. This isn't speculation. This is the disclosed positioning of the funds managing tens of trillions of dollars. The new institutional model looks closer to 60/10/30. 60% equities, same. 10% traditional bonds, a fraction of before. 30% in a third category, alternatives and real assets. That third category includes infrastructure, toll roads, pipelines, data center networks, utilities with inflation linked pricing. It includes private credit, loans to businesses that pay above market yields not available in public markets. And it includes real assets, commodities, real estate, gold, things that have intrinsic physical value that paper assets don't. The logic is straightforward. When inflation is running at 3.8% and professional forecasters see 6% coming, paper promises erode. Things with physical utility don't. JP Morgan's 2025 long term capital market assumptions project a 10-year expected return on core bonds of around 4.5%. Their projection for diversified alternatives, 7 to 9%. The institutions are following the math. Now, the honest version of this for your situation, you cannot directly access most of what CalPERS holds. Private infrastructure funds and private credit have minimum investments that start at six figures. That access gap is real, and I want to be clear. This is how the mechanics work, not a recommendation for what you personally should do with your money. But the exposure is increasingly accessible. Listed infrastructure funds hold the publicly traded versions of the same infrastructure assets. Real estate investment trusts give exposure to real estate income streams. Commodity funds track real asset prices. Some alternative asset platforms now offer retail access to private credit with minimums starting at $500. The architecture of the new model is available to you. The question is whether your current portfolio reflects it or whether it's still running on a framework designed for a world where inflation stayed quiet. The investors who built wealth through inflationary cycles didn't do it by staying in the model they inherited. They updated their assumptions when the conditions changed. The conditions changed. CalPERS voted on it in November 2025. Inflation confirmed it in April 2026. The signal has been in the institutional data for years. Your portfolio is a set of decisions you've already made. The question is whether those decisions were made for the world you're actually living in now. If you found this useful, if it made you look at your portfolio differently, the most important thing you can do right now is share it with one person who needs to hear it. Not for me, for them. Most people don't know the model changed. You do now. Pass it on. If you're watching on YouTube, subscribe. Every video on this channel is built around one idea. The financial system has rules most people were never taught. That changes here. New episode every week. And if this raised more questions than I answered, drop them in the comments below. I read everyone. Next week on Wealth Velocity, institutions aren't just repositioning away from bonds. They're moving into something specific, something with physical utility that cash and paper assets don't have. Next week, we break down exactly what real assets are, why investors are moving into them right now, and what that shift looks like at your scale. The episode is called Why Investors Are Moving into Real Assets Again. It goes live next Thursday. Don't miss it.